Let's be honest, who doesn't like the idea of getting paid just for owning a stock? You wake up, check your phone, and a company you own stock in has already deposited a few dollars into your account. No extra work, no selling anything, it just shows up, and that feels pretty good. But then there's the other group, the so-called boring investors. They tell you to stop overcomplicating things. Buy the entire market, sit still, and wait for 30 years. That's it. So which approach is actually right? I'm Paul, and today we're comparing dividend investing in index funds, not just returns, but the psychology behind them. First, what does it even mean when a company pays a dividend? When you buy stock in a company, you become a part owner. A tiny part, sure, but still. Some companies make so much profit that they can't reinvest all of it efficiently, so they give part of it back to you. That's a dividend. It's real cash that gets deposited straight into your account. Big established companies have been paying dividends for decades. Some have even increased their dividend every year for more than 25 years straight. The number you'll hear most is dividend yield, the annual dividend divided by the stock price. If a stock trades at $100 and pays $4 a year in dividends, that's a 4% yield. Simple math. You don't have to pick individual dividend stocks either. You can invest in a fund that holds a whole basket of dividend-paying companies at once. So instead of relying on one company, you're getting dividends from dozens, sometimes hundreds, all at once. So what are the actual advantages of dividend investing? First, income without selling. In retirement, you're not forced to liquidate shares. You're living off the cash your portfolio generates. Your portfolio might be down on paper, but if the dividends keep coming, you can stay calm and avoid panic selling. Second, psychological stability. Seeing cash arrive on a regular basis helps people stay invested during market crashes. Third, dividend growth. Strong companies don't just pay dividends, they increase them over time, which can help offset inflation. But there are important downsides too. Dividend investing often leads to concentration in a few sectors, which means you're not fully exposed to the broader economy and may miss out on higher growth areas. Dividends are not free money either. When a company pays one, the stock price usually drops by roughly that same amount. You're not gaining extra value, you're just getting part of your own investment back in cash, and it's often taxed right away. And then there's the trap almost everyone falls into, chasing high yields. A yield of 8 or 9% looks incredible, but in most cases it's a warning sign that the company is struggling or about to cut that dividend. Now let's talk about index funds. The idea is almost stupidly simple. You buy a fund that tracks the largest companies in the country, and instantly you own a tiny slice of every single one. This philosophy is backed by decades of data showing most professional fund managers can't consistently beat the market. So instead of trying to pick winners, you simply own the entire market. So what are the advantages of index funds? First, diversification. Since an index fund holds many companies, poor performance from one stock has a limited impact overall. Another major advantage is cost. Some index funds charge as little as 0.03% a year, compared to around 1% for actively managed funds. That difference sounds small, but over 30 years, it becomes massive. They're also tax efficient, because they don't trade frequently, which means fewer taxable events chipping away at your growth. And historically, the market has averaged around 8 to 9% annually over long periods, though past performance doesn't guarantee future results. But there are downsides too. The biggest one is the lack of an income stream. Your portfolio might have a high value on paper, but to fund your lifestyle, you need to sell shares. Doing that during a market downturn feels genuinely uncomfortable and goes against most people's instincts. There's also something called sequence of returns risk. A bad crash right at the start of retirement can lock in losses at the worst possible time. And honestly, the simplicity itself is a downside. Staying disciplined with something boring is harder than people expect. When markets drop and there's no cash flow to reassure you, that's exactly when investors panic sell at the worst moment. Okay, let's make this real. Let's say you want $60,000 a year in retirement income. On the dividend path, at a realistic yield, you'd need roughly $1.7 million invested. Your income shows up automatically. Bad year in the market? It might not even matter, the dividends usually keep coming. But your portfolio is less diversified. On the index fund path, using the well-studied 4% withdrawal rule, you'd need about $1.5 million, actually less than the dividend path. Your money likely grows faster because you're exposed to the entire market, but to get that income, you're selling shares every year. And when the market's down, that feels brutal. A bad crash in your first few retirement years can do damage that's hard to recover from. So which one actually wins? Honestly, it comes down to which strategy you can actually stick with for 30 years. But based purely on the numbers, index funds come out ahead: lower costs, broader diversification, historically stronger returns. Dividends win somewhere else though, not on the spreadsheet, but in your ability to sleep through a crash without touching anything. Here's the thing almost nobody says out loud: the biggest mistakes never came from picking the wrong strategy. They came from behavior. Panic selling during a crash. Chasing a yield that was too good to be true. Or never investing at all because you're stuck searching for the perfect answer. There isn't a perfect strategy. There's just the one you'll actually hold on to. I'm Paul. Thank you for watching. See you in the next video.